Tax season can be one of the most confusing time, especially for homeowners. In today's Teach Me Tuesday episode, we are going to break down some of the most common tax benefits of homeownership. We're going to talk about what documents you should be looking for, how certain life events like buying, selling, or refinancing can help impact your tax return, whether you got to pay money back or whether you get a refund. So whether you're a first-time home buyer or if you're a seasoned homeowner, this episode will help you file your taxes a little smarter and help avoid leaving some things on the table. So welcome guys to another Teach Me Tuesday episode. We're in the thick of tax season. Everybody should have gotten their W-2s and 1099s, 1098, and whatever mortgage statements and whatever you use to file your taxes, you should have them by now. So we're just going to, one, giving a disclaimer. We are not, a licensed tax preparer, CPA, or anything like that. This is just our own personal opinion and some just based on our experience in the business of things you can look for, things that can kind of just help you out as you go into your tax season. All right, so Gavin, LaShawn here. Wilmot is under the weather, so we definitely hope he feels better soon, but let's just kind of get right in it. So the first thing up, one of the things I know that we talk about a lot, especially when we do like first-time home buyer workshops and seminars, one of the benefits of home ownership versus renting is mortgage interest deduction, right? When you rent and you're paying someone else's mortgage, you don't have the luxury of mortgage interest. And so you don't have the luxury of taking that deduction from your taxes, which could then, help lower your tax liability and maybe either save you some money or give you a refund back. So, Gavin, let's talk about what is mortgage interest deduction, and does, we kind of talked about that a little bit, like, does everyone get it? What do you think about that? Do you think that's a good benefit, or how do you feel about when it comes to actually deducting? What kind of documentation people may need, or what should they be looking for when they go to file their taxes and they're a homeowner?
So here's what's important to understand about it, right? First of all, it doesn't apply to everyone.
Good to know.
Yeah. So that's good to know. I mean, the myth is that everyone thinks that mortgage interest deduction when it comes to your taxes will apply to you if you're a homeowner, and that may not be the case. So you can potentially deduct the interest that you paid on your mortgage, if you itemize your deductions instead of taking the standard deduction. So we all get a standard deduction on our taxes for single, married, jointly, head of household. You get those standard deductions. So your itemized deductions have to outweigh your standard deduction in order to benefit from the mortgage interest deduction. So, your lender, we'll send a document called a 1098, which shows how much interest you paid for the year. But just because you have a mortgage doesn't automatically mean you'll benefit. So for many homeowners, especially in the early years of your loan or with lower balances, the standard deduction still may make more sense. So if you aren't paying as much interest during the year, to be able to itemize, the standard deduction is your best friend, because that's been rising year after year.
Yeah, I like
this
that.
is why I always say, don't assume, just verify between the itemization and you using your standard deduction.
Yeah, one thing I would probably add to that is I know everybody has their own like philosophy when it comes to filing taxes. If you're like us, we file our own taxes. Or if you're like others, you may have we prepare our own taxes, probably the better way to say that. Or if you use a CPA or you go to H&R Block or something like that to get your taxes done, you don't have to necessarily know this information for yourself. You can definitely rely on the person that's assisting you with your taxes to kind of guide you on, like what Gavin said, is it better for you to itemize, or if it's better for you to take your standard deduction. Usually it's whichever one is the highest is the one that you want to go with. All right, so let's roll on to the next one to see if we can make it through all of these before our time today. Property taxes. Can homeowners deduct property taxes, Gavin, on their taxes, do you know?
Well, yeah, I mean, property taxes are another common deduction that a lot of people ask about. A lot of important. It is an important deduction. So yes, property taxes can be deductible, but the caveat is that there's a cap. So state and local tax deductions, including property taxes, are capped at $10,000 total. So,
Mm.
I mean, in most cases, you may not exceed that, but or even come that close to it. But just
I guess it
understand
only comes into place if like if maybe like I'm thinking of like a person who may own more than one
one,
property or
correct,
something like that. So they have several property taxes possibly. Or I guess property taxes are both not just your home, but it could be your cars or vehicles too. Right.
correct,
So
absolutely.
that's what I'm
That's a
thinking.
great point. So this is especially important for homeowners with higher price homes per se, or like you said, multiple properties, because you may not be able to deduct the full amount that you paid on all of those collectively. So again, very situational, and it's not the same for everyone. But for your standard, traditional homeowner that owns one property, or may have just purchased, this is definitely a benefit to you. But just know that that cap is there of $10,000.
Yeah, good deal. Like one other tip I would like to give when it comes to just filing taxes. So of course, if your goal is to become a homeowner in 2026 or the future years to come, you just want to make sure that that the information that you're filing on your taxes is as accurate as it can be, right?
Mhm.
Because there are situations where a mortgage lender will ask for your tax returns. I know some people may think that you generally have to be self-employed in order for us to use taxes. But a big one is that a lot of people, especially first-time home buyers who may be interested in down payment assistance and things like that, your tax returns, can sometimes make or break, whether or not, we can still qualify you for those programs based on how you file your taxes. So, Gavin, you kind of mentioned two things in the beginning. You were saying your filings, your marital status, right? Some
Right.
people may file single, married filing separate, married filing jointly, head of household, so forth. You got to be careful. And they may claim dependents that may or may not be there. You just you gotta be careful to make sure that what you're actually filing is as accurate as possible because it could have some implications when you
Mhm.
go to qualify for first time home buyer programs, down payment assistance, and how you actually report that stuff. So that's just a little word to the wise. Just watch out for the stuff you file on your taxes. I would just say it
Right.
like
Yeah.
that. All right. Go
Well,
ahead.
I
You want
think
to roll into number three? Go ahead.
yeah. Moving on. So I guess we work with a lot of first time home buyers. So let's
Yes.
talk about maybe the myth of what or the misconception of what people think about first time home buyer. And is there a credit? There's a deduction. What is it for people who bought a house last year in 2025 and filing their taxes in 2026?
Yeah, that's a good question. I think, and don't quote me on this, that I know back in the day, when we had different administrations in the office, I know that there were some first-time home buyer tax credits that people could take advantage of back then, but those things have now, they're not there anymore. That's probably the best way to say that. So there's currently no federal first-time home buyer tax credit. You no longer can take any type of credits for, or you're not no longer given any type of credit for being a first time home buyer. I think this is definitely a very common misconception because, like I said, in previous years, like back in the early 2000s, when we had different administrations in the White House, there was a first time home buyer credit. There's not one anymore. But buyers do often confuse a tax credit with deductions. So credits and deductions are two different things. Um, the deductions is actually what reduces your taxable income, and credits on the other end is kind of like your dollar for dollar type of savings. So you just want to make sure that once again, if you're doing your taxes yourself, just make sure you're really reading up on that, using the help tutorials that's on whatever site you use to file your taxes, or, of course, if you're working with a reputable, tax company, they can definitely assist you with that too. And then there are some state or local programs that you may benefit from that will
Mhm.
allow you to take some additional tax credits and deductions. I know one program that we work with a lot is an agency called South Carolina Housing Authority. They do have something called a mortgage credit certificate, or some people may say an MCC. So that particular credit does allow you, if you qualify, you have to have some type of tax liability to go in there and help reduce some of your tax liability. And it can definitely come in handy to a lot of people who may, want to try to avoid, necessarily owing a lot of taxes back, or in some cases, it can be beneficial to them to help you get a refund too.
Hmm.
So yeah,
Good stuff. Okay.
yeah,
Well, what about, well, let's I guess let's hit on number four. So
okay,
what about people who maybe sold a home in 2025 or in previous years, and we're not going to dive into it, but what about capital gains from the sale of that home? The one
yeah.
you're selling.
So yeah, for some sellers, you got to be, careful. You must have definitely lived in the home at least 2 out of the 5 years, and it must be like your primary residence to try to avoid, having to pay a capital gain tax. So you can be excluded from that if you have lived in your home at least those two. So this is really a lot of real estate attorneys like to make sure they kind of stress that, at closing, like when you go to sign your paperwork and they ask, like, hey, do you plan on occupying this home, as your primary residence? Is really more so geared towards maybe people who are investors and may own more than one, or maybe own more than one property, and they try to flip properties and sell them. It tries to help with slowing down that by usually being penalized with some type of capital gain
Right.
tax or whatever. But to avoid that, you just have to live in the home, hold it for a little longer, and you can kind of avoid that. All right, so let's go into this one, which is how become very popular right now.
Oh
We
yeah.
have been doing a ton of refinances, home equity lines of credit, cash outs. We have been doing a lot of that. But before we kind of dive in, if HELOCs and that interest payments and things like that, if any of that stuff is deductible, Gavin, can you just give us like a brief overview of what does that stuff mean when a person wants to refinance? Like what is that? Are they
Yeah.
applying for a whole mortgage again, or can they just ask to change their terms? Can you give us a little information about that?
Yeah, yeah. I mean, so in theory, yes, a refinance is pretty much you're starting over your loan. You have an existing loan to where you're now changing the terms, whether you're going from a 30-year to a 15-year, or you're going from a 30-year to another 30-year loan. To get most cases, you're either pulling equity out of your home or you're changing lowering your interest rate. A lot of people
But I
do
have a
this to
question now because you,
consolidate
you
debt.
you said something about starting over. So I have a question. Sorry, I'm sorry to
Right.
interrupt, but I get this question asked a lot, and I didn't want to forget it because it'll leave my mind. So
Hmm.
people want, you said, like when you're refinancing, you're basically starting over. Now,
Hmm.
because I had a client ask me that. So is a person really, if they already had, let's say they took out a 30-year mortgage, they go to refinance, so they're doing another 30-year mortgage. Is that their only option?
It's not their only option. So you can reduce your loan term.
Okay.
So you can go from 30 years down to 25 years, 20 years, 15, depending on where you want your payment and what you're comfortable with. So you can lower the term of your loan. However, in certain, if you're looking to get equity out of your home and you still want to keep the lowest monthly payment, more than likely you're going to refinance to another 30-year term. And the people who do that, like again, they're looking to get the equity out of their home to use it to, do home improvements, whatever it may be, consolidate debt, um, and continue to keep a lower monthly payment, to so that you can live freely, live a little bit better. But what I will say about that when it comes to um, deducting and whether you can deduct the interest from those deals um, is where people get tripped up at. So interest can be deductible only, or can be deducted only if the funds were used to improve the home. So if you use a your cash out refinance funds to, do debt consolidation, go on a vacation or any other
Mhm.
personal expenses, that interest usually does not qualify. So, it's documentation matters here at this point. Um, you have to, the how the funds are used matters. You have to keep good records and be able to, uh, show proof of where those funds went to. So this is a very common mistake that people do make during tax season. But you guys are not going to make it because we kind of hit on it, and
Yeah.
you're going to consult with your tax professional.
Well, good to know. All right. So before we wrap up, and I know these 15 minutes are going by so fast. So
Mhm.
before we wrap up, we're going to just jump down to our last point, and really talk about, documents homeowners should gather before filing their taxes. As you are, preparing to go ahead and get, those taxes filed, even though you have time, you have typically until April 15th to file your taxes. So don't wait till the last minute, because another pro tip, depending on the loan program that you're seeking to qualify for, especially loan programs that has down payment assistance and things like that, some of those programs do require you to file your most recent tax return. They will not take a tax extension, so just kind of keep that in mind. So
Right.
my suggestion would be to go ahead and file them and don't wait till the last minute. But when doing so, here are some documents that you will need. Gavin already mentioned the mortgage interest statement, or that 1098. If you already are a homeowner, that your mortgage company should have already sent you that. You want to pull your property tax statement. So you want to go to your local county website and pull your tax statement so that you can see how much taxes you paid for all of the vehicles and or real estate property that you own. If you just bought or sold a home, you will have something called a closing disclosure. Some people may call it a master settlement statement, HUD one. People use different names, but you want to use that because that will have some important information on it that you can use to help go towards your taxes. You want to have you want to look up or may hopefully keep all this stuff in a nice folder or file cabinet if you did any type of home improvements, because there are tax deductions for making your house more energy efficient and things like that. So I just want to, like solar panels, you get some deductions and stuff for that. And then last but not least, rental income. Oh, that is a big one. I know some people may want to report rental income, some people may not. So it's pros and cons to doing both. But my professional advice to you is that if you own rental property, you want to make sure that you're definitely filing that Schedule E and showing some of your income and expenses when it comes to that. So that is our time today, guys.
Mhm.
Gavin, you want to add anything else before we close out?
No, just people got file your taxes and
Value tax.
consult with a tax professional when doing so, somebody you trust, and um, you know we have recommendations. So if you aren't too sure what you need to do, uh, definitely reach out to us, because we can help advise you on, especially those who are self-employed, what you need to show and what you need to file in order to afford the home that you want to buy in this year or in years to come. So consult with us, consult with your tax professional, and let's get it done.
Let's get it done. All right, guys. See you guys next week. Have a great week. Bye.